Okay, great. It looks like everyone's come through from the waiting room. So good morning and welcome everyone, and welcome to RSM's 2021 financial reporting update. My name's Ralph Martin. I'm the National Technical Partner at RSM. That means I deal with accounting standards, audit standards, ethical standards, but mostly my favorite thing is IFRS and accounting consulting. So looking forward to talking to all of you today. I'm joined by Anna Espinal-Ray, Anna's a senior manager in our technical team, and Anna is, as well as being an accounting standards specialist, she has a particular focus on the not-for-profit industry. So I'm very pleased that Anna can join us today. Probably everyone's familiar with Zoom webinars by now, but for anyone who isn't, if you have any questions as we go, do use the Q&A box at the bottom of your screen. Just type in the question and we'll do our best to answer as many questions as we can over the course of the presentation. Don't be shy, you can ask them anonymously if you wish, but we love having questions. So yeah, please do ask questions if you have any as we go through the course of the presentation today. So I'll be talking for probably just a little bit over an hour, and I thought I'd start with some good news, in that if you have been attending these presentations, either from myself or anyone else in the past few years, you'll have heard a lot about revenue, financial instruments, and leases, because those have been what I call the big three new accounting standards over the past few years. The good news is they were all implemented either last year or the year before, and to some extent I'm taking them as assumed knowledge now, in that everyone's implemented them for better or for worse, and I won't be talking about them again today. If you do have any questions about them, do feel free to get in touch with Anna or myself, but we won't be talking about them very much today. The other thing I won't really be covering today is AASB 17 insurance. Now, if you are in the insurance industry, this is a really big deal for you. It's a new standard that's quite different for how we measure and manage insurance contracts. But that is a very niche topic I'm aware of, that probably isn't suitable for a general audience. So if you're in the insurance industry and want to talk to us about that, do get in touch and be happy to go through it with you. So that's what we won't cover. So what will we cover? Well, what I'll probably spend the most time on today is the end of special purpose financial statements, or the removal of special purpose financial statements, initially for some for-profit entities. That's a really big deal for a lot of entities, so that's the biggest topic this year. So I'll talk about it from the for-profit perspective, then I'll go on and talk about it a little bit from the not-for-profit perspective too. There are some upcoming changes to accounting standards, nothing as big as in previous years, but there are some that are important, and we'll cover those. And then I'll finish by talking a little bit about IFRIC agenda decisions, which may not be something you spend a lot of your life thinking about, but in some cases can be quite important. So I'll talk a little bit about what they are and how they can affect you. So let's start with a little bit more good news. Reporting deadlines. So recently the ASIC announced that for 2021 they're doing effectively the exact same thing as they did for 2020, which is to give everyone an extra month to report. So listed public companies and the like have 4 months rather than 3, and private companies have 5 months rather than 4. So most large private companies now have until 30th of November. Now, I don't expect this to be of much interest in the listed sector, because what the ASX have said is that in that sector, you'll still have to file your unaudited accounts after 2 months. After 2 months, so you don't get any extension for that. And in our experience, most entities want to get the unaudited accounts either audited or pretty much virtually right after 2 months. So then it generally isn't a big deal to get the audited accounts in after 3 months. Where I expect this to have much more applicability is in the private sector, where 5 months rather than 4 will probably be a welcome extension to the deadline for a lot of entities. The other thing that has continued is what ASIC called their no action position for AGMs. So the background to this is that when the Corporations Act was drafted in 2001 or a few years before, virtual meetings, Zoom, Skype, whatever, like we're doing right now, wasn't really contemplated as a potential technology for AGMs, probably because it didn't really exist in a meaningful sense back then. So the assumption was that an annual general meeting had to be a physical meeting held in a physical place where everyone would attend physically. Clearly, in the current environment, that's not necessarily the case, but the law isn't actually clear. It's really silent as to whether you can hold an AGM virtually. So what the ASIC have confirmed is, should you do that, they will be taking no action. In fact, they actually rather encourage people to hold AGMs either virtually or in a hybrid model because it allows more shareholders to attend. So they will have what they call a no action position. And if you hold your AGM virtually, that's fine. The one caveat to that is it does have to be a genuine meeting. So it can't just be a presentation. It has to be a genuine meeting where shareholders have the opportunity to interact and ask questions to the directors and meaningfully interact with them. And as well as that, they've also extended the deadline for holding AGMs by 2 months. So that's the good news in the for-profit sector. In the not-for-profit sector, there's no change to ACNC deadlines, but they were a little bit longer anyway, so that's not such a big deal.
Well, we've got 2 questions on this topic. The first one is in the listed sector, is the requirement for reporting with unaudited accounts also after 2 months? Does that also apply to mining and exploration companies?
Good question. So for mining and exploration companies, there is effectively a 1 month extension to the deadline for audited accounts, which means rather than 2.5, you have 3.5. Sorry, 3.5. You have 4.5 months. But similarly, the old deadline for unaudited accounts didn't apply in the mining and exploration companies, so there's no change there. Yeah, no change there, and no change to existing requirements for exploration companies other than the 1 month extension for your audited accounts.
And then just confirming, because I think there might be a perhaps a typo in the slide, but the listed companies, when we're saying 2 months, what they have to file after 2 months is unaudited accounts, we're saying.
Oh, you are quite correct. That's a typo. Fixed. Yeah, it should be unaudited accounts after 2 months.
And then just confirming what you said in that last bullet point in the slide, that there is no change to ACNC.
Correct. Not for profit, no change to your deadlines.
Thank you.
Okay. So let's go on and talk about the move from special purpose to general purpose financial statements. And we accountants do love a good acronym, don't we? So we're going from SPFR to GPFR and RDR to SDS. What on earth does that all mean? Well, the background to this is Australia has something that's really almost unique globally, which is this reporting entity concept. So the idea behind this is that for most privately owned companies, you have, as a director, what you're required to do is go and say, do I think there are any users who rely on these accounts to make decisions? That can be decisions around investing, about lending, around finance, and so on. And if there are, I have to prepare general purpose. And if there aren't, I can prepare special purpose accounts. And special purpose accounts really theoretically should comply with all of the recognition and measurement requirements of accounting standards, but I can really choose whatever disclosures I like to go in there. Now, that's a unique concept that really doesn't exist in other countries around the world. And in my mind, the reason it doesn't exist in other countries around the world is there's kind of a fundamental flaw to it, which is that what the government says is, if you're a large proprietary company, I, the government, think you are large and economically significant enough that I'm going to make you lodge audited accounts on the public record where anyone can go and download them. But you still need to assess whether you have users who depend on those accounts or not. Well, the problem with that is once those accounts are on public record, anyone can download them and you have no idea who's downloading them and you have no idea what purpose anyone's using them for. But yet you still have to make this assessment. So the reporting framework at the moment effectively puts directors in an impossible position, making an assessment they just really can't accurately make. And this has long been seen as a problem within Australia. AASB has known this as a problem for a while. So yeah, the way it works at the moment, if you're listed or other publicly accountable entities, you do full IFRS accounts. If you're a private company and you don't, but you still need to do general purpose accounts because you have dependent users, then you do the reduced disclosure regime, the RDR. But most other companies decide that they don't have dependent users and prepare special purpose accounts, SPFR. So currently around 70 to 75% of all accounts that are lodged with ASIC are special purpose financial statements. So what's changing? Well, as I've explained, the current reporting framework really doesn't make sense. And so what the AASB have done is passed a new standard to say that for for-profit entities, certain for-profit entities, special purpose financial statements are going to be removed. A new standard that does that. But it is important to be clear on the definition of exactly who's having special purpose financial statements removed. So this is a bit techy, but I am going to go through it in detail. So firstly, entities required by legislation to prepare financial statements in accordance with accounting standards or Australian accounting standards. So either accounting standards or Australian accounting standards. Or entities required by constituting or other document to prepare accounts in accordance with Australian accounting standards. Note the difference there, it doesn't say accounting standards, it just says Australian accounting standards. So quite a key distinction there. So let's talk a little bit more about what that means. So if you have to prepare accounts in accordance with legislative requirements, and most entities affected by this, that's going to mean the Corporates Act 2001. But there are a number of for-profit entities that have to prepare accounts under other legislation, whether it be the Aboriginal Corporations Act or certain state and territory legislation. So if that's you, what you need to do is go and look at the legislation and see whether it refers to either accounting standards or Australian accounting standards. I'll make it easier for you if you're under the Corporates Act. It does refer to both of those things. So you must now prepare general purpose financial statements from 1st of July 2021. So 30th of June 2022 is the drop dead application date. So that's the easy bit. The harder bit is, what about the non-legislative requirements? Firstly, it refers to a constituting or other document. And that can really be anything. I've put some examples on the slide here. It can be a constitution, partnership agreement, joint venture agreement, or a bank agreement. I'd highlight that one because that's, I think, one that's going to catch a lot of people out. If you have a bank loan and the loan agreement says you have to give accounts to the bank, it says that those accounts must be prepared in accordance with Australian accounting standards, then you're potentially caught by this. So those are some examples of what a constituting or other document can be. Similar, again, a lot of joint venture agreements say the joint venture must prepare accounts in accordance with Australian accounting standards. There is a slight twist to this, that there's effectively a grandfathering clause. So if you have one of those documents and it's not prepared or modified before 1st of July 2021, then you're grandfathered and you don't need to prepare general purpose financial statements. Problem is, if the document is modified after that date, then you must prepare general purpose financial statements. So imagine a typical bank loan agreement here. Big loan agreement might have been signed way back in, say, 2016 for a 10-year loan. But what happens every year? Very common for the banks to update the terms and conditions. And there'll be a clause in the loan agreement to say that they can do that every year. And then they do that every year. That means they're modifying the loan agreement every year. That means if you have a bank loan agreement and it has a reference to preparing an account in accordance with Australian accounting standards, then you are at risk of inadvertently now having to prepare general purpose financial statements. So if that affects you, my advice is you've got until 1st of July to do this, but actually because of the way it works, you've really got until 30th of June 2022. I would start negotiating with the other party to see if you can remove the reference to Australian accounting standards and replace it with something generic term, such as commonly accepted accounting principles. But if you remove the reference to Australian accounting standards, you will potentially scope yourself out of the requirement to prepare general purpose financial statements. I emphasize this is only for people who are preparing accounts just because of a constituting or other document. If you're caught by the legislation, there's really nothing you can do, and you will have to do general purpose financial statements from now on. So, if you do have to prepare general purpose financial statements from now on, what does that mean? What do you have to do? Does it have to be full IFRS compliant financial statements? The answer is no, not necessarily. There is a new accounting standard, AASB 1060, which is the Simplified Disclosure Standard, so SDS. When you're referring to SDS, that's what those initials stand for. And what SDS does is, firstly, it does apply to both for-profits and not-for-profits. I'll explain how it applies to not-for-profits a little bit later. Mandatory from 1st of July 2021, but I'll explain why you might wish to early adopt in certain circumstances, because there's some rather good transitional relief available. It replaces the existing reduced disclosure regime. So if you do accounts under the reduced disclosure regime at the moment, that is going to cease to exist in just over a year's time. So you will have to transition to Tier 2 SDS. It is a disclosure standard only. It does not affect recognition and measurement. So if you're under SDS, under 1060, you will have to apply all of the recognition and measurement requirements of Australian Accounting Standard. Lastly, while it is based on IFRS for SMEs, it is not IFRS for SMEs. IFRS for SMEs is a separate framework that doesn't exist in Australia. It exists in some overseas jurisdictions that has simplified requirements for the actual recognition and measurement of things like intangible assets, financial instruments, deferred tax, and so on. Doesn't exist in Australia, but 1060 is largely based on the disclosure requirements of that standard. So, how is all this going to affect different types of entities? Well, if you're a for-profit entity and you're currently preparing special purpose financial statements and you're still able to do so, in other words, you aren't caught by either a legislative requirement or a constituting or other documents, maybe you do it just voluntarily, then you can still prepare special purpose financial statements, but you will need some additional disclosures in there from 1st of July 2021 about whether you comply with all of the recognition measurement requirements of accounting standards, whether you comply with consolidation and equity accounting, we'll talk a little bit more about that later, and why it's appropriate for you to do special purpose financial statements. If you're preparing special purpose accounts and can't do so anymore, then you have a choice, and it's probably going to be a fairly straightforward choice. You can either do Tier 1 full IFRS accounts, that's probably going to be relatively rare, or you can do Tier 2 general purpose financial statements, the new SDS, which I'd imagine what most entities will do. If you're currently doing Tier 2 reduced disclosure regime accounts, you will have to transition to Tier 2 SDS. You will have to do that. RDR will cease to exist and be replaced by SDS. You're currently doing full IFRS financial statements, for example, you're a listed company, then none of this affects you. No change, you'll continue to do exactly what you've always been doing. Okay, and we'll talk in a little while about not-for-profit framework. I emphasize this, everything I've said so far only affects for-profit entities for now, but we will talk a little bit about how it affects not-for-profit entities in a moment. So, if you are preparing special purpose accounts at the moment and they're having to go to general purpose, and as I say, this is about 70 to 75% of all entities that lodge accounts under the Corporations Act. So first thing to say is it's now explicit that the recognition and measurement requirements of all accounting standards do have to be applied in full. There was some ambiguity about that before. Some entities were lodging accounts with assets that didn't comply with consolidation and equity accounting were the big two, but also things like deferred tax, leases, even financial instruments in some cases. Now there's no argument on any of that. You must apply recognition and measurement in full, including the consolidation and equity accounting standards, in particular AASB 10. There's a lot of entities that lodge special purpose accounts with ASIC. They were only lodging it for the holding company, and then they had all the activity in trading subsidiaries, but they weren't applying AASB 10, so they were just showing all of that as an investment in subsidiary. That's gone, so that will be a big change. That will be a big change for some of the entities that lodge special purpose accounts with ASIC at the moment. The other big thing that's new is related party disclosures. There won't be any opt-out, there won't be any commercial sensitivity exemption. If you have related party disclosures, then there are some in SDS and you will have to apply them. If you're currently doing RDR accounts, then I have good news and bad news. Good news is actually SDS has quite a few less disclosures than RDR. So I've highlighted some of the main ones here, revenue and discontinued operations, 2 examples, but probably the biggest one is the financial assets and financial liabilities disclosures. There's the detailed disclosures about measurement bases and about how you measure all of your financial instruments could be quite complex to do, as could the disclosures around loss allowances, in other words, your bad and doubtful debts provision. So both of those are actually removed under SDS when compared with RDR. However, there are some additional disclosures going back in. So if you did RDR previously, you didn't have to put in either audit fees or imputation credits. You will do in the future. Probably the biggest disclosure there is the third one, the leases one. Maturity analysis of future lease payments. That can be quite a lot of work to do if you have a lot of leases, but it is a required disclosure under SDS. Okay, let's talk about the transitional provisions. So, as I said, the adoption date for this is 1st of July 2021, which means for most entities, 30th of June 2022 will be the first year of adoption. But it may be, if you're affected, it may be well worth your while early adopting by a year. The reason I say that is if you early adopt it 2021, you only get a small amount of transitional relief. Basically, the relief is you don't have to distinguish errors, changes in policy, and the impact of adopting general purpose. You can just sort of lump it into one big set of transition adjustments. If you early adopt by a year, though, you get that relief, but you also get an optional relief from restating comparative information. And if there are new disclosures that you previously didn't have to do and now you have to do them, you get a relief from providing comparative information for those disclosures. So it's actually quite a bit easier to early adopt the 30th of June 2021 than it is to wait until 30th of June 2022 and adopt them. So we are saying that to our clients that are affected by this. If you are affected by this, think very carefully. It's probably worth early adopting by a year. Okay, I've touched on all of that at a relatively high level, but just a little bit of self-promotion here. If you do feel like you need more information, go and click on that link, and there's an article where we go through this in a little bit more detail, explain a bit more detail what disclosures are required and who's in each tier. So do go and have a read about our article.
The start of this slide is a good point to ask a confirming question that somebody's raised earlier when you're talking about the impact of basically the removal of special purpose financials. And you said if you are a charity, there is an optional, it's optional to adopt SDS. And the question was, how about charities with more than 1 million in turnover? So charities that are currently large, are they captured in what you said, basically?
Yeah, good question. And let's go on and talk about not-for-profits now. So yeah, everything I said at the moment only applies to for-profit entities. There is no change to reporting obligations for not-for-profit entities at the moment. But that's because there's an ongoing review to the not-for-profit financial reporting framework, which really started back in 2018. And the findings from that review was firstly that the current size thresholds for not-for-profit entities are a bit too low. And secondly, that there's also insufficient disclosure for those not-for-profits that do report, particularly around related party transactions and also around remuneration disclosures. So there is an ongoing review into the not-for-profit framework at the moment. And that's probably a good point for me to hand over to Anna as our not-for-profit specialist to talk us through in more detail what's going to happen in the not-for-profit sector.
Thanks, Rob. So yes, I can talk a little bit more to this. Hopefully by the end of the next few slides, we'll have answered that question thoroughly, but obviously do pop your question back into the Q&A box if you're not satisfied with our answers. So obviously the background to this is this legislation review from 2018, and in late 2020, at the end of the review, there were some recommendations, and among them, based on these findings, there was a recommendation, especially addressing the first bullet point, which was to review the thresholds. So currently, charities with that excess of $1 million of turnover are those that are considered large. And really, the view was, well, this is actually very low in current circumstances, and maybe it would make more sense, first of all, to look at a rolling 3-year period, which would help with some issues with the application of accounting standards for not-for-profits. And also, if you look at a rolling 3-year period, you might get a more accurate picture of revenue in the charity. So then the idea is we're not just going to double the thresholds, but actually we're going to look at them and see how we can increase them quite significantly. The important thing is this has not yet been finalized, so I can't tell you that this applies this year. And actually, it's part of a broader review that feeds from the government's response to that legislation review, to those findings and those proposals. So since August 2020, there have been some targeted consultations with stakeholders around what a new financial reporting framework should look like. So is it fair, for example, that there's these 3 levels of, these 3 size levels, basically, of charities, but really there's still only a general purpose or a special purpose approach to preparing financials? Should there be something else? Should charities be able to do something else? So really, there's some ongoing deliberations about what the financial reporting framework will look like. And we don't yet know exactly when the results of this are going to be known. It is very much an ongoing project. And in fact, at the AASB meeting earlier this week, there was still an ongoing deliberation about what's next. It is very much at the forefront of their mind. So we are hopeful that there'd be a possible implementation by the end of 2025, which I appreciate sounds quite far away, but in the world of accounting standards, it actually moves quite quickly. So the AASB's objective is to get a consultation paper on what they are actually proposing in terms of this new framework by the end of 2021. And once a consultation paper gets issued, there's sort of more targeted outreach, there's options to provide feedback on that paper. That then eventually becomes an exposure draft, there's more commenting. It basically goes back and forth quite a lot, which explains the 2025 projected timeline. So what this means is that until then, charities that have turnover of more than $1 million are considered large, and large companies have to put audited financial statements. And if the charity can still self-assess whether or not it is a reporting entity, even if it is large. Though I would advise to bear in mind Ralph's initial comment at the start of this, which was the idea that if you're being made to report, justifying why you are a non-reporting entity feels a bit counterintuitive. There is that option is available. If you look at your requirements on the ACMC website, it will highlight that. But very much because AASB 1060 is a new standard that applies to not-for-profits and for-profit entities, there is still a requirement for charities that are preparing currently general purpose, reduced disclosure financial statements to move those to SDS financial statements. And the same principles as Ralph highlighted just before will apply, in that there will be actually not that much difference in terms of disclosures. Some disclosures will go away, some new disclosures will appear. Fundamentally, your financial statements will look the same because you're still preparing full recognition and measurement compliant financial statements, because you're already preparing general purpose financial statements. However, this is not actually a new standard. This standard that was issued alongside ASB 1060 or the removal of special purpose for certain for-profit financial for-profit entities. However, it's one that takes even more relevance in the context of these changes. Basically, this take effect in the year end June 2020, so already last year. And it basically was an amending standard that said, look, special purpose financial statements of not-for-profit private sector entities are prepared. We know they are prepared, but we don't really know to what extent they comply with recognition and measurement requirements of the standards. We don't really know to what extent they consolidate all entities that they control. We don't really know to what extent they do equity accounting. And we want to know. And so there was this standard that was introduced that said, okay, if that's you, if you, for example, don't comply with full recognition and measurement, then you have to tell us. So, excuse me, technical issues. So basically, at the moment, the disclosures are required if you do prepare special purpose financial statements and you're a charity or a not-for-profit in general. You have to tell your users 4 things. First of all, why you have prepared special purpose financial statements. Because ultimately, there's that idea that if you're putting financial statements out into the universe, someone may want to use them to make decisions, especially in the context of not-for-profits. They may want to use them to make decisions about how they use their money. So tell the users why you've prepared special purpose financial statements. If, as an entity, you have interest in other entities, tell them also whether or not you've applied the consolidation standard or the standard that requires you to equity account for associates or entities over which you have significant influence. And if you do not do that, explain why not. And if you've not actually made the assessment as to whether or not you do that, explain that the assessment has not been made and explain. And then if you have any material accounting policies that do not comply with recognition and measurement requirements of the standard, explain how they do not comply, or that the extent of the non-compliance has not been assessed. That is obviously a less useful statement than an explanation as to the ways in which your financial statements may not comply with an accounting standard. But as long as there is enough disclosure to allow you to understand exactly what is in your financial statements, that is the objective of these disclosures. And then really an extra overall statement that says, overall, having considered all of the above, do the financial statements comply with all recognition and measurement requirements in Australian accounting standards? And again, if you've not actually assessed that you have not assessed that. So really, this is just to provide much more information to users while there is a potential transition to a new reporting framework for not-for-profit. I'm hopeful by this point I've answered that question from the start.
Yeah, I guess the one thing I'd add to that is that the financial reporting framework for not-for-profits hasn't been finalised yet. So if you're doing special purpose, that's fine, and you can carry on doing that. I would say it's overwhelmingly likely that at the point that they raise the thresholds, we talked about raising medium from 250 to 1 million, large from 1 million to 5 million. At the point they raise those thresholds, they will almost certainly abolish special purpose financial statements for not-for-profit entities in the same way they've done for for-profit entities. That's still yet to be finalised. I can't tell you that for certain. But if I was a betting man, I would be putting my money on that's what's going to happen.
That's very true, especially in the context of not-for-profits, where even if you think, yes, you have directors, you have owners, governments, creditors, the ATO, the extent to which you can assume that those people are not users is quite debatable. So I would also possibly be putting my money on that same bet, and I'm very much not a betting person. So, okay, well that's basically the extent of this sort of accounting framework update. The other side of things we wanted to touch on briefly on not-for-profit financial statements is revenue and income. And this is not to go into detail around into the standards, because again, we're going to assume this is a level of assumed knowledge. I want to highlight a couple of things about the standards, having had a year of implementation, and a year of seeing some difficulties in applying the standard, or some things that people may think of as actually more flaws in the standard. So there's 2 areas that in particular we wanted to highlight, and that was around particularly government grants. received by not-for-profit entities, especially for not those that are used for building assets, recognizable assets, but government grants that are funding projects and activities. And the two main issues that recur in this area are, first of all, identifying basically whether the grant agreement can be said to be in scope of AASB 15, and that relies on that key point as to whether there are A, performance obligations in the contract, in that is there a transfer of a good or service, but also are those goods or services actually sufficiently specifically identified to be able to identify when you have completed and transferred that obligation. Really, there's an ongoing issue with determining that. And then there's another point we wanted to highlight, which was around clauses in some government grants, which are termination for convenience clauses. There's been quite a lot of discussion in the public sphere around how to interpret these clauses. This conversation has basically taken off this year quite a lot with the implementation of 1058. And so we just wanted to highlight some views on that. A reminder, though, at this point that AASB 120, which is the standard that is called accounting for government grants or government assistance, does not actually apply to not-for-profit entities. So very much when we're talking about application issues with government grants in not-for-profits, we're not talking about AASB 120. So the main impact in practice is that the government grants are often given for specific purposes, for restricted purposes. So you will often apply for it. It will be given by a specific government department who will have an allocated pool of funds to donate as grants to achieve certain objectives. However, the problem is that a purpose or a restriction on use is not itself a performance obligation. So the fact that the government has said you must use this money to perform this activity, or you must use this money to recruit 3 people, or you must use this money to only for general expenditure related to a particular area. Those are very much restrictions on use, in that you cannot go and use that money for anything else, because the funding agreement will often be enforceable, in that the government would be allowed to claw back that money if you breach those terms. However, on their own, those terms are not performance obligations. They do not transfer a good or a service either back to the government or necessarily to a third party. In fact, they just help you as a not-for-profit use those funds and deliver on your objectives, because that is why you've applied for the funding. And so the problem is that as a result of how the standards work, entities end up having to recognise income up front. Now, that wasn't actually a new problem. The old standard 1004 on contributions actually resulted in that conclusion quite often when applied properly. And then when the new standard was issued, I think there was a lot of hope in the sector that would change, and income would maybe be more able to be deferred and released over time, and there'd be more, dare I say, use that word, there'd be a more opportunity to use the matching concept, as much as that word sometimes is used in ways that doesn't mean what it actually means. But so the problem we have is that there's a new standard that's been issued. A lot of work has gone into implementing it, to assessing contracts, to really understanding how the two standards link together, how 1058 and 15 link together. And then we've actually resulted in a position where we don't actually get that different a result. And we've actually had to think an awful lot about it to get there. And so really there's a question in the sector, which is this standard actually fit for purpose? There has been some negative feedback received by the AASB. And in fact, this week, there was an additional agenda point in the AASB's board meeting minutes that followed some targeted outreach done by the AASB that we've been very heavily involved in terms of providing our feedback on these difficulties with this standard and how we do not necessarily feel it is actually resulting in useful financial information. So the AASB has acknowledged that there are perhaps some areas that need reviewing. However, there is a reluctance to do a complete overhaul at this stage, because part of the AASB's process is to do a post-implementation review of the standard, which is due to start next year. But again, realistically, the impact of that review will not be seen for a few years. So we're very much involved. We're working with CA and Z on getting more information out there as to how the standard works at present, while at the same time lobbying, for lack of a better word, arguing quite heavily for a better standard, which would really help better reflect the economic substance of transactions for not-for-profits. So very much watch this space. It is, change feels like it might be coming, but it'll be a bit slow. But we're very much going to continue making some noise in this area.
And if you do feel you've been adversely affected by ASP 1058, do get in touch with me. I'd love to hear from you, because that can form part of the body of evidence that we're working with CANZ to present to the Accounting Standards Board. Because at the moment, I guess the position is there's a lot of complaining, but it's a matter of turning anecdotal complaining into a hard body of evidence to say, if I can answer my own question, that ASP 1058 is not fit for purpose. Because my view is that it isn't. It results in accounts that just aren't true and fair. You often get situations where there's a huge income recognised in one period and huge surplus in one period and huge deficit in the other. That just isn't the economic reality of what's happening in those entities.
However, so I'll highlight just at this point, just because we mentioned termination for convenience clauses a couple of slides ago, and we've been talking about disclosure requirements more generally, is that in the meantime, if you are in the not-for-profit space, the encouraged, I guess, follow on, if you do have these strange revenue recognition patterns where you have a big income in 1 year, but it's very restricted in use, very much what we're encouraging people to do and still comply with the standard as it is currently drafted, is to just add as much disclosure as possible to explain very much the story, to make sure that your accounts, even if the income statement looks not as you would hope, not as you think truly and fairly represents your financial position, as long as your disclosures add enough context and enough story to actually explain why that is the case, that will go some way towards helping your users understand those financials. Okay.
Thanks, Anna. The last thing I wanted to talk about very quickly in the not-for-profit, particularly the government sector, is ASP 1059, service concession arrangements. Now, this is a fairly niche standard, but it does have quite a lot of impact in some entities. What it affects most is public sector entities, where there's a service concession. And typically what we're talking about here is things like where there's a big infrastructure project, and it could be things like bridges, tunnels, toll roads. We've seen it for things like power plants, even prisons occasionally, where the owner basically grants service concession to someone else to say, you go away and run that asset, you do all the management, operation, maintenance, collect all the income from it, and in return you pay me a service concession fee. Could be an annual concession fee, could be a big upfront concession fee. So an example here, and this is one we've seen a fair bit, is for example, a university has an accommodation block and they grant to an operating company the right to run that accommodation block. The way the accounting works in that situation is what the university would have to do is recognize a service concession asset, when they grant that service concession, and also a corresponding liability. Both of those get amortized over the period of the service concession arrangement. But that's a very quick overview of what can be quite a technical and challenging standard. So if you are affected by it, do feel free to get in touch with me. I'm happy to talk through it in more detail. Okay, the thing I did want to go and talk about is what is changing in accounting standards, because while we don't have any major new standards here, we do have some changes to existing standards that can have quite a significant impact in some cases. First thing, the observant among you may have noticed in my initial slide, I said we're not going to talk about leases mostly. The reason is we need to talk about it a little bit now, because what there is as a change to IFRS 16 in respect of COVID-related rent concessions. Now, the background to this is, imagine a situation, and I would say certainly it would have happened in Victoria last year, and may happen in certain states this year. Wait and see. Is that you have a situation where say a retailer, for example, has to close their premises, either they close them entirely or they have very, very significantly reduced foot traffic. So they negotiate with the landlord a rent concession. Say for the next 6 months, I'm going to pay, only 20% of my normal rent because I've got very little income. So how would you account for that? Well, if you were to apply the lease standard IFRS 16 in full, what it would say is when you make a modification to a lease contract, you actually go and recalculate your lease liability, and the effect of that is the effect of that rent concession isn't recognised immediately, it's recognised over the entire remaining lease term. So I might be getting the 6-month discount, but if I'm have a 20-year lease on my retail premises, the effect of that discount will be spread over the next 20 years, whereas the drop in my income, of course, happens immediately. Now, that's an issue in terms of during our presentation. It's also an issue in that doing the accounting for lease modifications can be quite complex. So what the IASB said last year was that if you have a COVID-related rent concession, it has to be a COVID-related rent concession. You can treat it as a variable lease payment, and what that is a fancy way of saying just recognise the concession in the period to which it relates. So if you have a 6 months rent reduction, recognise it as income in those 6 months, recognise it as a credit to P&L at that time. The issue was at that time they said it had to be a COVID-related rent reduction where the rent reduction only happened up to 30th of June 2021. Anything beyond that had to be treated as a lease modification. They've now extended that by a year to 30th of June 2022. So yeah, if you are in the businesses that is getting any sort of rent concession, it's potentially good news for you. You can apply it in the current year. It doesn't have to be spread over the entire remaining lease term. All of this is for lessees only. No change to accounting for lessors. So I've gone through that quickly. The accounting can get quite complex, but if you do want to work through it, the starting point would be to go and have a read of our article. I put the link in the slide here. I know the article is really, really good because Anna and I wrote it. But it is good because it has about 6 or 7 worked examples that go in detail through how to account for a COVID-related rent concession, but also how to account for other modifications and changes to lease contracts. So work through that, and if you still have questions after reading it, then as always, do feel free to get in touch with us. Okay, next change to accounting standards is the definition of a business within AASB3, the business combination standard. Now, this sounds like quite a techie, nerdy sort of thing, and it is to some extent, but it can have a big impact on the accounting. And the reason is whether or not something's classified as a business can get you to a very different accounting outcome. If you buy a thing and you decide that it's a business, then what you have to do is business combination accounting. And that means you have to fair value all of the assets and liabilities you acquire, you have to fair value the consideration you pay. You then have to go and look for any other unidentified intangible assets. And that can be things like brands, trademarks, relationships, customer contracts. Capitalize all of them as intangible assets. And then based on that, you take your consideration from your net assets and work out your goodwill figure. So that can be quite a complex and involved process. If on the other hand, you buy a collection of stuff and it isn't a business, it's just assets, then the accounting, at least initially, is much simpler because all of assets you just initially recognize at cost. You don't end up with goodwill, you don't have to go and look for additional intangible assets or do any of that. So whether or not something is a business can be quite a big deal in reality. And what the change to AASB3 is, it's around the minimum requirements for having a business. Now, to have a business, you have to have inputs and processes that can be used to create outputs. Again, that sounds a bit like techno speak, but to explain that, so if our inputs and processes, that's things like, is there knowledge, are there things being done, are there employees doing things, are you taking goods that you receive and performing some process to make them more valuable? Are you taking inputs such as people's time and some code and doing work on it to create an output in terms of an intangible asset you can sell? This often comes up, particularly in the mining industry, actually in the listed sector, that if you just acquire an exploration company, probably actually isn't a business because it's just some tenements, to which some exploration may or may not have been done. That's just an asset collection. But if you acquire a producing mine, it has processes, it has customers, it has a market, it has all of that, and it would meet the definition of a business. So the accounting becomes quite different. So the example I give here is acquisition of a real estate company. So if I acquire a real estate company, what it's got is 10 properties, residential properties, all which have sitting tenants. Sure, there's assets there with customers in place, but actually the key bit there is the bottom. There's no employees, no assets or processes or other activities, and there's just these 10 family homes. That's not a business, that's just a collection of assets. So that's how I treat it for that accounting. I just recognize that there's 10 homes at cost initially. But what about if I acquire the same thing, but instead of that, it's 6 10-story office buildings, all of which are fully leased, all of which have existing contracts for cleaning, for security, for maintenance, and so on. And there's also employees, there'll be caretakers, lease managers, that sort of thing, office manager, to run and manage and maintain the building. Well, suddenly I've got processes there. Those are processes. That means I have a business. So rather than just treat it as an asset that I recognize as cost, I'm now going to have to work out whether there's additional intangible assets there in terms of my customer contracts, my management contracts, but potentially even things like software or customer relationships. So that's probably not huge in a commercial real estate company. I have a business and I'm going to have to do business combination accounting. So whilst reading that fairly closely, the rule of thumb and the guidance and the standard is that where you meet what's called the optional concentration test, which is substantially all of the value of what you're buying is encapsulated within a single asset, then it's probably not a business. And that's generally the case for things like early stage mining exploration companies, early stage research and development companies, or tech companies where you're just developing one thing. Might be some medical technology, might be some software, but all of the values in that one thing is not a business. So you would just recognize it at cost if you buy it for that one asset. Okay, so that's the first change. The next change I wanted to highlight was the classification of liabilities. And the issue here is whether debt is classified as current or non-current on the balance sheet, which has been a difficult and contentious topic for many, many years. And the aim of the IFB is to reduce diversity in practice in this area. So a reminder here of the background to this: to classify any liability as non-current, there must be an unconditional contractual right to defer settlement for at least 12 months. Keywords there: unconditional contractual right. So intentions and probabilities are irrelevant here. It's whether an unconditional contractual right exists to defer settlement. Now, this applies for 1st of January 2023, but I would say on this, remember the requirements of IAS 8, which is when there are standards or changes to standards issued but not yet adopted, then the effect of those changes has to be disclosed. And this is a standard where if you are affected by it, you will know the effect, because it'll just be the case that you have to classify certain debt from non-current to current. It won't be one of those where you can just say it's impossible to quantify the effect. It will be very much a known effect. So if you are affected by this, there may be a reasonably strong argument for just getting it over with and early adopting. But what is the change? Well, so there has to be a right to defer settlement for 12 months. What's been defined is a right to defer settlement. So that right to defer settlement must exist at the end of the reporting period, at the balance sheet date, in order to be classified as current. And classify the intention to settle or not settle doesn't affect its classification. So if I have a bank loan, it's a 10-year loan, I can choose to repay it at any time, but my obligation is only to repay all the capital at the end of 10 years. But I happen to know that I'm expecting a big windfall early next year and I'm going to use that to early repay my debt. Doesn't matter. I would still classify it as non-current because there is no unconditional contractual obligation to pay within the next 12 months. Similarly, if I go to the right hand side, if I have breaches with lending conditions, bank covenants, or anything like that, and those are in place at the balance sheet date, then I must classify as current, even if I only test for compliance at a later date, and even if by the time I test for compliance, the breaches have been remedied, doesn't matter. All that matters is, as at the balance sheet date, am I compliant with the terms of my loan, and therefore do I have an unconditional contractual right to defer settlement for 12 months? If I don't, then I must classify as current. The last thing that's changed, I highlight, is the middle slide here, the right, what's meant by settlement. The settlement's now defined not only cash settlement, not only cash, but also settlement in goods or services. If I settle by delivering some of my product rather than paying cash, that's still an obligation to settle. And lastly, settlement through the issue of equity instruments, unless it's convertible debt where the conversion option is initially classified as equity. Now, I'll come back to that in a moment, but that could be a big deal for some entities. So, the IASB have said they think this is a clarifying amendment. It only clarifies existing requirements. Therefore, it's not expected to affect companies significantly in practice. I don't agree with them. And the reason I don't agree is particularly around convertible debt and how that's treated. So, a little bit of a quick convertible debt 101 here. When you have convertible debt, it's bifurcated, it's split into two parts. You have the debt, the host debt, and you have the conversion option. Now, the debt you treat like any other debt, but the conversion option you will treat either as debt or equity. Whether it's debt or equity depends on whether it meets what's called the fixed test. If it's settled for a fixed number of equity instruments, then you may at inception classify it, or in fact you must at inception classify it as equity, which means you value it at that time only once and you never ever touch it again. It sits in equity. If on the other hand it doesn't meet the fixed test, so for example, something will meet the fixed test is you've got convertible debt. The conversion terms is that for every $1, when you convert it, you get 1 share. Fixed number of shares for a fixed amount of debt. But what about debt where, for example, the holder can convert it at any time, but the conversion price will always be, for example, your volume weighted average price less 10%. Pretty common sort of term of convertible debt. Well, that isn't for a fixed number of shares because it's dependent on the market price every day. So the conversion ratio changes every day. So that's for a variable number of shares. So that conversion option would not be classified as equity. It would be classified as a derivative financial liability. So what this amendment says is that where you have that sort of conversion option, then if the holder has the rights to convert at any time, then the entire instrument, including the debt, as well as the conversion option, must all be classified as current. Even though there may be no obligation to pay cash for another 5 or 10 years, because there's potentially an obligation to issue a variable number of shares within the next 12 months, that must be classified as current. So that will be a change in practice for some entities that have convertible debt for those terms. Okay. So those are the key changes to accounting standards. As always, if there are any questions, please put them in the Q&A box and we'll be very happy to do our best to answer them. So I thought I'd finish by talking about IFRIC agenda decisions. Now, unless you're an accounting technical nerd like me, you probably don't spend a lot of your life thinking about IFRIC agenda decisions. You may not have read one, you may not even have ever heard of them before. But they actually can be quite important. So I'll start by explaining what they are. So The way the standard setting process works is obviously you have the International Accounting Standards Board, the actual standard setting body sets accounting standards. It's supported by the International Financial Reporting Interpretations Committee, or the IFRIC. And the IFRIC exists to support the work of the Standards Board. And the way it works is people submit issues to the IFRIC. Anyone can do it. Anyone can do it and submit a query to the IFRIC about any aspect of IFRS. But what you would say in that query is, I think there's an issue in IFRS where the treatment is unclear and people are doing it different ways in practice. So can you clarify, please, IFRIC, how this issue should be treated? So what the IFRIC will then do is they'll consider it, and they'll do one of four things. Either they can issue an interpretation. They do issue accounting interpretations from time to time. There's no new ones this year, which is why I haven't mentioned them, but previously we've had interpretations on things like uncertain tax positions, on settling debt with equity instruments and so on. They're all on the AASB website, you can go and read them. But so the IFRIC can issue interpretations. They can also say, yes, we think the standard is deficient, so we're going to recommend to the standard setter that they either fix the standard, or in some circumstances, they initiate a project to write a whole new accounting standard. So those are two options available to them. The fourth option they have is to say to someone who submits a query to them, actually, we don't think accounting standards are unclear in this area. We think they're clear. We think there is only one correct way to interpret this problem. And here it is. So we're not going to take this issue onto our agenda. That's what an IFRIC agenda decision is. So IFRIC agenda decisions are what I call semi-authoritative. They're not standards, they're not interpretations, but they are decisions issued by an authoritative body. And a lot of jurisdictions, not Australia, but a lot of jurisdictions, including the whole European Union, have effectively legislated to make them authoritative pronouncements that carry the same weight as actual standards. All of which is a long-winded way of saying if you are complying with IFRS, you really do have to comply with these. So, having said all of that, let's talk about what the recent IFRIC agenda decisions are. Probably the one I'll spend the most time on is cloud computing, recent IFRIC on cloud computing. So the issue here is that the existing intangible asset standard was drafted a long time ago when software was quite a different thing to what it is now. It was probably drafted in the old days when you either downloaded or perhaps even you took your software home on a CD or a floppy disk, or you downloaded it from the internet, possibly, and then it sat on your computer or on your server under your control, and you used your software, and then you did whatever you wanted. So it can be treated as an intangible asset. However, in the modern world, very often what you have is a software as a service arrangement. So you don't own the software, you don't download it. It sits up in the cloud where the software developer owns, monitors, maintains all of that. And you just have access to use it whenever you like. So the issue there is how do I treat, if I have cloud software like that, where it's held, managed and monitored by the software provider, but I spend a whole lot of money on customizing it and configuring that cloud software to meet my business needs, how do I treat that cost? Can it be recognized as an intangible? So the IFRIC thought about that and they said, well, no, actually, those configuration customization costs wouldn't be an intangible because it's not an asset that you control. Yeah, the actual underlying assets, it's on someone else's server where someone else controls it. So you can't recognize it as an intangible. So what do you do with all of your configuration, customization costs? Well, the answer in good old-fashioned technical specialist fashion is it depends. It depends. And what it depends on is whether those configuration services are distinct from the underlying software. Can they be used to their own benefit separately from the underlying software? If they can, then you would recognize an expense at the point you receive them. In other words, at the point that the configuration and customization services are performed. If you can't recognize benefit from them separately, then they form part of the overall software as a service contract. So you would just treat it as a prepayment. You treat it as a prepayment, and then you would amortize the expense over the term of the software contract. The interesting thing there is, how do I work out whether my configuration and customization expenses are distinct or not? And what the IFRIC said was, go and look at the guidance on what is and isn't distinct within the revenue standard, IFRS 15. So we're talking about expenses here, we're talking about your computer costs, nothing at all to do with revenue, nothing to do with revenue, but they are saying go and look at the guidance in the revenue standard nonetheless. So not something you might intuitively think to do, but that is now the guidance on dealing with customization and configuration of cloud computing software. So if you are undertaking a big new software project that involves cloud software, that IFRIC standard decision is one you need to be familiar with. Okay, next agenda decision was on reverse factoring. Now, probably everyone's familiar with traditional debt factoring. You have a whole lot of trade receivables and you sell them to the bank, and the bank then collects them, and in return you get immediate cash, and obviously the bank will give you only a discount on the face value of those receivables. The way reverse factoring works is you've got a whole collection of trade payables rather than receivables, and you say to the bank, please pay all of those my trade payables immediately, thank you, and I will pay you the balance over time. And obviously the bank will do that and then charge you fees and interest for the privilege. The question now is, if I enter into this reverse factoring arrangement, do I present that reverse factoring debt as trade payables, or do I present it as a financing arrangement? And the answer was, once you're entering into that sort of arrangement with a bank, that is a form of financing. So you can no longer treat that debt as trade payables. Trade payables are things paid to suppliers for goods and services. You're now dealing with a bank who's extending financing to you. So you can't treat the reverse factoring debt as trade payable. You need to treat it as any other finance debt, like any other bank loan.
I'll just address a question that's come through the Q&A, which is, for software as a service, would the service provider treat the service charges simply as revenue and the cost of the hardware or software to deliver the services as an asset? Well, so here, let me just go back one slide here where we're talking about cloud computing. Although admittedly the question does not directly relate to the expenses side. So here the question is whether the provider of the software as a service simply charges revenue. So the question goes back to what is actually the contract for. And so the effectively subscription fee would have to be considered under the requirements of AASB 15 and revenue recognized accordingly. So if the service delivered is effectively a subscription, so you would refer back to the guidance on licensing in terms of how you recognize revenue there. The cost of the hardware or software would very much depend on, again, that word, it depends, would depend on the nature of what is being offered. And so you have hardware, the hardware would be the server effectively that's hosting the software that is being licensed effectively or provided as a service. And that is likely to be controlled by the supplier. So if the service provider is actually controlling that asset and it meets the definition of an asset, then it does end up recognized as an asset. The software itself, is it treated as an intangible asset? Well, again, you would have to work through separately in the specific instances of that contract, whether or not the requirements of AASB 138 are met. Hopefully that answers the question. I see Ralph has managed to find us, so I will just hand back over to him as I'm sure you're here to listen to him rather than me.
Thank you very much, Anna, and apologies for everyone. I got the blue screen of death literally while I was in the full flow of talking, so apologies for the interruption. Anna, can you just give me control of your screen?
Yeah, there we
go. So yeah, I think I just got to the end of talking about reverse factoring. I'll probably skip over the next one because it's a fairly niche one for certain jurisdictions, but going to talk about sale and leaseback with variable payments. And so this was quite an interesting interpretation on the new lease standard, because a bit of background on the new lease standard. Probably a lot of you are already familiar that when you work out your lease liability on the new lease standard and the corresponding right of use asset, you incorporate any payments that are in fixed and in substance fixed. If you have any variable payments, for example, rent that's a percentage of turnover, you normally don't incorporate that in your lease liability. You just recognize it as an expense as and when it comes due. The question to the IFRIC, though, was on what about if you have a sale and leaseback transaction, but instead of the leaseback being for a fixed rental payments, it's for variable rental payments. Does the same apply? So you would effectively have no lease liability. And the answer here was actually no. There is specific guidance in the in AASB 16 about sale and leaseback transactions. That means in this particular circumstance, you do end up recognizing a lease liability, even though you have variable payments. And I put paragraph 100A on the slide there that goes through the details of exactly how you calculate that lease liability. But that's the bit I wanted to highlight, that they did put, it was kind of an anti-avoidance measure in there, that if you do have, you can't avoid having a lease liability by having a sale and lease back and then making the payments variable. You still end up with a lease liability if you do a sale and lease back in those circumstances. Okay, last thing I wanted to highlight, and probably doesn't affect anyone here directly, but I thought it was kind of interesting, so I'd throw it in there anyway, was about football transfer payments. So again, background here is, in case anyone's not familiar, if you go and buy a football player, if I'm in Manchester City and I go and buy Cristiano Ronaldo for $100 million, then that's actually an intangible asset. It's an intangible asset because it's his contract rights that they're buying. Then, like any intangible, you don't amortize it over its useful economic life, which is normally the term of the player's contract, and you test it for impairment. So I'm a supporter of Bristol City, and based on their performance this season, I feel confident in saying all of their player intangibles are fully impaired assets now. But the question to the IFRIC was, so I've got these players, I bought them, and then I sell them. How do I treat the sale of players? Is it as revenue or is it as disposal of an intangible asset? That's actually quite important because a lot of the big European football leagues have what they call the financial fair play rules, which say you can only pay player wages up to a certain percentage of your revenue. So whether your player sales are or aren't in your revenue is actually a big deal in terms of who you can buy and what players you can get and how much you can pay them. So what the IFRIC said was, if you sell a football player, that is not revenue. That's a disposal of an intangible asset, and therefore has to be recognized within other income, not as revenue. And similarly, transfer receipts are shown as investing activity in the cash flow statements, not as operating activity. So as I say, there's a pretty niche, but I thought that was quite an interesting example of how what seems like a very obscure accounting interpretation is actually going to have quite a big real life impact on football clubs, who they buy, who they sell, which players they sign, and so on. So accounting standards do have a real world impact sometimes. Okay. That was everything we had to talk about today, but we'll stay on the line for a few minutes. If there are any questions or answers, do put them in the Q&A and we'll do our best to answer them. Other than that, I want to say thank you very much for listening to us this year, everyone. And if as you work through your financial statements for 30th of June, you do have any issues with anything we've raised in the presentation, do feel free to get in touch and we'll be very happy to talk through that with you. But otherwise, yeah, Anna and I will stay around for a couple of minutes for any Q&A. Otherwise, thank you very much, everyone.